Jack buys a rental property. Ryan invests in index funds. Same money, same income, same starting line. But 20 years later, their financial lives look completely different. And not for the reason most people think, because this isn't really about real estate versus stocks. It's about what people don't count when they run the numbers. Let's keep it fair. Jack and Ryan both have $60,000 saved. They both earn $65,000 a year. Same age, same city, same financial discipline. The only difference is what they do with that $60,000. Jack uses it as a 20% down payment on a $300,000 rental property, a clean 3-bedroom house in a solid middle-class neighborhood. He takes out a 30-year mortgage at 7% interest. His monthly payment, about $1,600. After a few weeks, he finds a tenant willing to pay $2,100 a month in rent. On paper, that's $500 in profit. $500 every month. For doing what exactly? Jack feels like he just hacked the system. Ryan takes a different route. He drops his entire $60,000 into a total stock market index fund. No leverage, no tenants, no late-night phone calls. He sets up an automatic contribution of $400 a month. Then he closes the app and forgets about it. When people ask what he's investing in, he says, index funds. The conversation ends there. No one leans in, no one asks follow-ups, because there's nothing exciting about it. On day one, Jack has a house, a tenant, and a story. Ryan has a login screen and a number. It's not even close in terms of how it feels, but feelings don't compound. Numbers do. For the first couple of years, Jack feels unstoppable. Rent checks hit his account like clockwork. He drives past a property sometimes just to look at it. That's mine. He tells his friends about appreciation, tax deductions, passive income. Everything about it sounds smart. And honestly, it is smart, at least on the surface. Meanwhile, Ryan logs into his brokerage account once every few months. The number moves, up a little, down a little, then up again. Year one, $60,000 turns into about $66,000. Year two, maybe $73,000. Nothing dramatic, nothing worth bragging about. No one asks him about it anyway. There's no social proof, no visible asset, no identity attached to it. It's just quiet growth. Now let's look at what's actually happening under the surface. By the end of year three, Jack has collected around $76,500 in rent. Sounds impressive. His mortgage payments total about $57,600. So that leaves roughly $18,000 in profit. At least that's what it looks like, until reality shows up. Property taxes, about $3,500 a year. That's $10,500 over 3 years. Insurance, another $1,800 annually. Now we're at $5,400. Already, that $18,000 is shrinking fast. Then come the surprises. A broken HVAC system, $4,500. Plumbing repairs, $1,200. A damaged fence after a storm, $1,000. And then, vacancy. Just 1 month without a tenant cost him $2,100 in lost rent, plus another $700 to clean, repaint, and relist the property. Now run the numbers again. That profit doesn't look like $18,000 anymore. It looks more like $2,000 to $5,000 over 3 years, and that's before assigning any value to his time. Because Jack isn't just an investor anymore, he's a landlord, which means phone calls at 11 p.m., weekend showings, negotiating repairs during lunch breaks, chasing late payments. He didn't buy an asset, he bought a responsibility. Ryan's situation, he's now invested $60,000 up front plus $14,400 in monthly contributions. At an average annual return of around 10%, his portfolio sits at roughly $90,000. He hasn't taken a single phone call, hasn't fixed anything, hasn't lost sleep over a tenant. But here's where things get interesting. Jack still has something Ryan doesn't: leverage. That $300,000 property, it's now worth around $330,000 to $345,000. Even a modest 3 to 5% annual appreciation makes a difference. His equity, what he actually owns after subtracting the loan, is now somewhere around $75,000 to $90,000. That's real wealth, and part of it came from the bank's money. That's the advantage real estate investors love to talk about. And they're not wrong. Leverage can accelerate wealth, but it also amplifies mistakes. Here's the part most people skip. The rent number is the headline. It's what gets clicks. It's what gets attention. But it's not what you keep. Because between that rent check and your actual profit, there's a long list of things waiting to take their cut. Vacancy. Even in good markets, expect at least a few weeks or a full month without a tenant each year. That's income dropping to zero while expenses stay exactly the same. Maintenance. A good rule of thumb is 1 to 2% of the property value per year. On a $300,000 home, that's $3,000 to $6,000 annually. Some years it's nothing. Other years, it's everything at once. Then come capital expenses. Roofs don't last forever. Neither do water heaters or furnaces. If costs, they're when costs. And they don't show up gradually. They show up all at once. $6,000, $10,000, $15,000. If you're not planning for them, they'll wipe out your profits overnight. And then there's management. If Jack hires a property manager, that's 8 to 10% of rent gone instantly. If he doesn't, he becomes the manager. Either way, there's a cost: time or money. Pick one. By year 5, the reality starts to settle in. Jack has gone through multiple tenants. He's dealt with repairs he didn't expect, expenses that weren't in the original calculation, and stress he didn't plan for. Yes, the rent has increased slightly, maybe now it's $2,300 a month, but so have property taxes, so has insurance, so have repair costs. His actual return, closer to 4 to 6% annually after everything. Not bad, but not the 15 to 20% he thought he was getting. Ryan, he's still doing almost nothing. And that's exactly the point. His portfolio has grown to around $130,000 to $150,000 by year 6. Not because he made brilliant decisions, but because he didn't make emotional ones. He stayed consistent, kept investing, didn't panic during dips, didn't chase trends. And now, something subtle starts to happen. His money begins to grow faster than his contributions. The gains start generating their own gains. This is where compounding quietly takes over. At first, it feels slow, almost disappointing, but then it starts accelerating. And once it does, it doesn't ask for your time. It doesn't need your attention. It just keeps going. This is the moment where the gap begins to form. Not necessarily in total wealth yet, but in how that wealth is created. Jack's growth requires effort. Ryan's growth requires patience. Jack is actively working for his investment. Ryan's investment is working for him. Both are building wealth, but one comes with friction. The other comes with time. And by year 7, that difference becomes impossible to ignore. Jack is still managing his property, still dealing with tenants, still handling repairs, still thinking about that house more often than he expected to. It's no longer exciting. It's routine. Sometimes it's frustrating. Meanwhile, Ryan's portfolio has quietly grown to somewhere between $160,000 and $180,000. He didn't change anything, didn't optimize, didn't upgrade, didn't scale. He just stayed consistent. And now the curve is starting to bend upward. Here's what most people miss. In the early years, real estate feels like it's winning. You can see it, touch it, talk about it. Stocks feel invisible. But over time, visibility becomes irrelevant. Math takes over. By year 10, both Jack and Ryan decide to actually sit down and look at their numbers. Not the surface level numbers, the real ones, the kind that include everything. Jack's property is now worth around $400,000. His remaining mortgage balance is roughly $200,000. That gives him about $200,000 in equity. On paper, that's a big win. And it is. But then he looks deeper. Over the past decade, he's spent money on repairs, vacancies, property taxes, insurance, maintenance, unexpected emergencies. And when he adds it all up, his total additional out-of-pocket costs beyond the down payment lands somewhere between $25,000 and $45,000. That's money that doesn't show up in the equity number. That's real cash that left his pocket. Then there's the part no spreadsheet tracks perfectly. His time. Hundreds of hours, maybe more. Time spent managing, fixing, coordinating, worrying. Now compare that to Ryan. Ryan's portfolio? It's sitting somewhere between $190,000 and $210,000. He contributed $60,000 up front plus $48,000 over 10 years. $108,000 total. Everything above that? That's growth. That's compounding. And it didn't require his time. At year 10, they're surprisingly close. Jack might still be slightly ahead. That leverage did its job. But the cost of getting there looks very different. Jack took on debt, concentrated his investment in a single property, accepted illiquidity. He can't just sell a bedroom if he needs cash. Ryan? He spread his money across thousands of companies, stayed liquid, and never owed anyone a dollar. This is where the story really separates, because the next 10 years don't behave like the first 10. By year 15, Jack's property is worth around $470,000 to $500,000. His mortgage has dropped significantly. His equity is climbing, but so are the long-term costs. At some point during those years, he replaces the roof, $9,000, upgrades the HVAC system, $7,000, deals with a difficult tenant who stops paying, 3 months of lost rent, legal fees, stress. That one event alone erases a huge chunk of his yearly profit, and it's not rare, it's part of the game. Ryan, on the other hand, hits a different kind of challenge, a market crash. Maybe it's a recession. Maybe it's something unexpected. His portfolio drops 25 to 30% in a matter of months. That $250,000 account is now closer to $180,000. No broken pipes, no tenants. But psychologically, this is brutal because unlike real estate, stock prices update in real time. You see the loss every day. And most people, they panic. They sell. They lock in the loss, then buy back in later after the recovery. That's how average investors underperform the market. Not because the market fails them, but because they fail to stay in it. But Ryan doesn't sell. He keeps investing. Same $400 a month. Same strategy. Because he understands something Jack is just now learning the hard way. Consistency matters more than timing. Now fast forward to year 20. This is where everything becomes clear. Jack's property is now worth somewhere between $550,000 and $650,000. His mortgage either fully paid off or very close. That means his equity is massive. Let's call it $500,000 to $650,000. That's real wealth. And now, for the first time, the property truly starts to feel passive because there's no mortgage payment anymore. Rent comes in, expenses still exist, but the biggest one is gone. This is the version of real estate people dream about. But it took 20 years to get here. Now look at Ryan. His portfolio, with a 10% average return and consistent $400 monthly contributions, has grown to roughly $500,000 to $580,000. He invested a total of about $156,000 over those 20 years. Everything else, growth, compounding, time, no debt, no tenants, no emergencies. So when you compare net worth, they're in the same range. $500,000, maybe more, maybe less depending on the market, but close enough to make one thing clear. Neither strategy crushes the other, at least not on paper. But here's the part that actually matters. how they got there. Jack built his wealth through effort, through management, through stress, through leverage, through concentration. Ryan built his wealth through patience, through consistency, through discipline, through time. Now here's where the math quietly shifts again. Let's change just one variable. Instead of investing $400 a month, Ryan invests $600. That's it, an extra $200. Nothing dramatic, but over 20 years, that small change pushes his portfolio closer to $650,000, even $700,000. Why? Because in the stock market, increasing your contribution doesn't just add more money, it multiplies through compounding. In real estate, increasing your investment usually means buying another property, another down payment, another mortgage, another set of problems to manage. Scaling isn't just financial, it's operational. Now, to be fair, stocks aren't perfect. They come with real risks. Volatility is one of them. Watching your portfolio drop 30% is not easy. Most people say they can handle it until it actually happens. Then there's the lack of income. Stocks don't send you meaningful monthly cash flow. Dividends exist, but they're small, maybe 1.5 to 2% annually. Not life-changing. Not at first. And real estate, it has advantages stocks simply can't replicate. Leverage is one of them. Tax benefits are another. Depreciation allows property owners to reduce taxable income, even when the property is increasing in value. That's powerful. There's also control. Jack can improve the property, raise rent, force appreciation. You can't renovate an index fund. So what's the answer? Which one actually wins? The truth is, the winner isn't the asset. It's the investor. The one who understands the full picture. The one who accounts for time, effort, risk, behavior, not just returns. Real estate works incredibly well if you treat it like a business. Stocks work incredibly well if you treat them like a system. But the biggest mistake is choosing either one based on hype. A YouTube video, a tweet, a conversation with someone who only shows the upside. Because both paths work, and both paths fail, depending on the person walking them. So the next time someone tells you real estate always wins, or stocks are the only way, ask them one question. Did you include everything? Because the answer that includes everything is the only one that matters.